How you doing, everybody? This is Kurt Henry at the Mortgage Center, and we are mortgage brokers. We work with multiple banks and lenders and to get them to compete for you to get the best deal when you're getting a mortgage. And this is a weekly mortgage update to let you know what's going on in the mortgage market. There is a lot going on right now in terms of mortgage rates. They are going up, and they have been steadily going up over the last few weeks. That's referring mostly to fixed mortgage rates. And there was some new mortgage rules that came into place just yesterday, November 30th. In addition to other new rules that came into place on October 17th. And the result of these rules is that it's putting the interest rates, the mortgage rates up. So basically the changes that happened yesterday mainly refer to mortgages whereby the borrower is borrowing 80% of the value of their house or less. So it used to be that, you know, when a bank was doing a mortgage for 80% of the value of the house or less, they would get that mortgage insured by CMHC, for example. Now, most consumers know CMHC as, you know, a premium that you have to pay when you buy a house and you have less than 20% down. But what CMHC also does is when, you know, banks and lenders are giving mortgages when people have 20% down or more, CMHC also insures some of those mortgages, but it happens on the back end. So the consumer doesn't even know that that's happening. It's just the banks just do it on the back end. And the reason why the banks insure those mortgages on the back end, and again, those are mortgages where the mortgage is 80% of the value of the house or less. The reason why banks and lenders insure those mortgages with CMHC is because it makes it cheaper for them to raise those funds. Because when banks and lenders have those mortgage monies insured, they can sell those mortgages into mortgage-backed securities a lot easier and a lot quicker. But what has happened is that CMHC is not insuring a lot of those mortgages anymore, and that's what happened. That's what took place as of yesterday. So what it means is that banks and lenders, when they're raising money for these mortgages with a loan-to-value of 80% or less, banks and lenders have to raise those funds a different way, and it basically means that those funds are more expensive to banks and lenders in doing that, because it takes a lot longer for them to get that money off of their books when those funds are not insured, and so therefore those funds are not as liquid to banks and lenders, and therefore if it's not as liquid, it's more expensive. So basically what's happening is banks and lenders are increasing their fixed mortgage rates, and a lot of times it's only on the fixed mortgage rates where the loan to value is 80% or less, which creates a very strange situation, which is that if somebody has less than 20% down, they might actually be able to get a better mortgage rate than if there's 20% down or more. And the reason is, again, because of the cost of funds to banks and lenders being more expensive when there's 20% down or more versus when there's less than 20% down. The banks, you know, when they're raising that money, those funds are cheaper. So it's a long explanation, but hopefully it clarifies. Just give me a call if you have any questions. Phone number here is 905-436-8010. Thanks, and have a great day.